Hello students, welcome to the second part of the lecture of question 1. In the last lecture in question 1, we studied the entries in the books of transferer companies alpha and beta. Now same question we will see the entries in the books of transferee company, that is Gamma Limited. Okay, so today same question 1 we are going to look at the entries and the balance sheet also. You can look at the last question, last paragraph, what is asked to you. First part we had done, now this second part, bracket onwards. Also pass journal entries in the books of Gamma Limited, that we are going to see today, and prepare its balance sheet immediately after the amalgamation. So that also we are going to see today. But before we take up with that, we just revise and recollect the few points done in the last lecture. I told you that very first we have to identify, is it merger or purchase. There are three conditions of merger. 1. All assets and liabilities should be taken over. This condition is satisfied, which is visible from the second sentence, which takes over all assets and liabilities of both the companies. Second condition, at book values. Throughout the paragraph, no other values are given for assets as well as for liabilities. That means they all are taken at book values. Only debentures value is given, but that too is given as 2 lakhs only. It means it is taken at book value. So second condition is also satisfied of merger. And third condition, the purchase consideration should be entirely paid in the form of equity shares only, except the fractional amount can be paid in cash. Here if you look at this sentence, entire amount payable in the form of equity shares. So these three conditions of merger are satisfied. Further, now since we are passing the entries in the books of transferee company, we studied in the past lectures that if it is amalgamation in the nature of merger, then we have to apply pooling of interest method. So we are going to pass the journal entries in this question by which method of accounting? Pooling of interest method of accounting. All of you can pause this video, and if you have any confusion, then refer to the summary and go through properly the 7 journal entries which we have studied in pooling of interest method. Those entries we are going to pass. So let's take up with the entries in the books of Gamma Limited. Very first entry, if you refer in the summary, was to take over the business. The entry for the same was business purchase account debit. Okay, business comes in, debit what comes in. So business purchase account debit. Now business purchase account debit with the total purchase consideration, and amount is payable to the liquidator of transferor company. Credit the payables. So to liquidator of transferor, now here there are 2 transferor companies, so we'll write both. To liquidator of Alpha Limited as well as to liquidator of Beta Limited account. Okay, to liquidator of transferor company, so liquidator of Alpha Limited and to liquidator of Beta Limited account. Now what amounts? Purchase consideration. If you see this paragraph, 19,50,000 is the consideration for Alpha Limited and 6,80,000 is the consideration of Beta Limited. So liquidator of Alpha Limited, we will record 19,50,000, and liquidator of Beta Limited, we will record 6,80,000. Total purchase consideration of both the companies, 26,30,000. Being business of Alpha Limited and Beta Limited purchased. Yes, now before we pass the second entry, if you all refer to the concept studied in accounting entries in the books of Transferee company, we discussed that before we pass this second entry for taking over assets and liabilities, assets account debit at book value, to liabilities at book value including reserves. This will be including fictitious assets, and to business purchase with purchase consideration. We will make this workings. What workings? We have to find difference between purchase consideration and share capital of transferor company, and that difference we have to transfer to P&L account. So very first, let us find difference between the purchase consideration and share capital of transferor company. We'll make that working note 1 over here. If you see, the share capital of transferor companies are 15 lakhs and 6 lakhs. First you note down that. Okay, in the workings all of it after the format of journal. Okay, journal 1 page format. Then all of you write down share capital of Alpha Limited. Okay, share capital of Alpha Limited 15 lakhs as we have seen in the balance sheet. Then same share capital of Beta Limited 6 lakhs. So total share capital of both the companies taken over is 21 lakhs. Okay, as we studied in the notes, we have to find difference between share capital and purchase consideration. So share capital minus purchase consideration. Now if you see the question, then purchase consideration of Alpha Limited is 19,50,000 and Beta Limited is 6,80,000. So total purchase consideration for both the companies is 19,50,000 plus 6,80,000, that is 26,30,000. Now against 21 lakhs we are paying 26,30,000. How much more we are paying? 5,30,000. We are paying more, means from transferee company point of view, it is called loss on acquisition. Okay, what is it called? Loss on acquisition. If you are paying less, it is profit on acquisition. If you are paying more, it is loss on acquisition. Now this, as we studied in the notes, we have to debit to P&L account. We have to transfer it to P&L account, but as it is a loss, we have to debit it to P&L account. Now all of you understand one thing. Before we debit this to P&L account, both the companies already have this circled amount of reserves. All of you can see here. What amount of reserves? This reserves 1,50,000 of security premium, 15,000 of capital reserve, 4,70,000 of general reserve, and 1,89,360 of profit and loss account. Now understand the concept. In the books of Gamma Limited, Alpha and Beta are going to get merged. Now in the books of Gamma Limited, on one side we cannot say that we have these reserves, and in the same balance sheet we cannot say there is again a loss on acquisition of 5,30,000 also. Means one company, Gamma Limited, after the merger of Alpha and Beta, cannot say that it has loss also and profits also. Reserves are nothing but the profit kept aside from the business. They are accumulated profits. So any particular entity, forget about a joint stock company, any one particular entity cannot say that it has profit also and loss also. So what are they supposed to do? This loss on acquisition 5,30,000, they have to write off from this reserves. And if there is a favorable balance, reserves are more, then net amount only we will credit to P&L account. In case if loss is more, then net amount we will debit to P&L account. But keep it in mind, in the same balance sheet, you cannot say you have accumulated profit also and loss also. So let us find out the total balance of these reserves first. Security premium 1,50,000. All of you write down in the same workings below. Total favorable balance of reserves is equal to, okay, total favorable balance of reserves is equal to 1,50,000 of security premium plus 15,000 was of capital reserve plus 4,70,000 of general reserve. Okay, all of you can see that in the balance sheet. So plus 4,70,000 of general reserve and plus 1,89,360 of P&L account. Okay, 1,89,360 is of P&L account. So what is the total balance of all the reserves combined together, favorable accumulated profits? Okay, 4, 5, 550, 620, 720, 8 lakh, 8 lakh. I repeat, 4 lakh, 5 lakh, 550, 620, 720, 8 lakh 9 plus 15, 8 lakh 24,360. You all can add it in your calculators. From this we will write off. Okay, this loss on acquisition we have to write off from reserves. So from this we will write off the loss on acquisition of, from this we will write off the loss on acquisition of 5,30,000, and as reserves are more, loss is less. So what is the net favorable balance we will credit to profit and loss account? 2,94,360. 2,94,360 of favorable balance we will credit to profit and loss account. If loss was more and reserves were less, then what would we have done? If loss was more and reserves were less, then the difference amount we would have debited to P&L account. Here, reserves means accumulated profits are more, loss is less. So net amount of profit only remaining in the company we credit to P&L account. So in this second journal entry, we will not record liability with these reserves. Why? Because these reserves are used in writing off the loss. So we will just record one reserve, that is P&L account credit with 294,360. So if we pass the second entry now, assets account debit. Now assets account debit means very first land and building will debit with 5,60,000. So all of you write down at book value. Assets account debit at book value. So land and building account debit 5,60,000. Then next asset is plant account debit. Now plant with the total amount. Okay, plant account will debit with the total amount. What total amount? 9,42,000 plus 3,60,000. Total plant in the Gamma Limited. They are acquiring Alpha Limited's plant also, Beta also. So 9,42,000 plus 3,60,000. What is the total plant in Gamma Limited? We will record now. Plant account debit 9,42,000 plus 3,60,000. So in Gamma Limited now the plant is worth 13,02,000. Then after plant, which is the next asset, we have furniture. So furniture account debit with again 1,01,500 plus 89,500. Okay. Total plant in Gamma Limited will be worth what amount? Sorry, furniture will be worth what amount? Furniture account debit with Alpha Limited's furniture 1,01,500 plus Beta Limited's furniture 89,500. So 1,91,000 of furniture in Gamma Limited now after acquiring both the companies. Then after furniture, which is the next asset? Stock. Again with the total amount of both the companies. So stock account debit. Okay, after furniture write down stock account debit with what amount? Alpha Limited's stock is 537,340. Okay, write down in bracket 537,340 plus what is Beta Limited's stock? 252410. Okay, 252410. So 5 plus 2, 7, 730, 780, 787, 789, 750. Then cash and bank account debit. Next asset is cash and bank account debit. Now what are the amounts of cash and bank of both the companies? Alpha Limited's cash is 401590. Okay, 401590 plus Beta Limited's cash and bank is how much? 118190. So plus 118190. Total cash and bank is how much? 401 plus 118. So 5,19,000 and then 740. Sorry, 780. Okay, 401590 plus 118190, 519780. So this is assets account debit with book value. Now to liabilities account at book value. Now liabilities, security premium will not come, capital reserve will not come, general reserve will not come. Only P&L account will come as per the working note done. As per the working note done, P&L account will come with 294360. Okay. So to profit and loss account, 294 from working note 1, 294360. Now question is why general reserve, capital reserve, security premium will not come? Because they all are written off. They all are used in writing off the loss. So after writing off the loss, net balance of P&L account which we write 294360, that automatically includes general reserve or security premium also, capital reserve also, general reserve also, P&L account also. All these amounts are combined into this 294360 after writing off the loss of 5,30,000. So we will write only this P&L account credit as per working note 1, 294360. Other than that, which liabilities do we have? To 10% debentures account. Alpha Limited has no debentures. Beta Limited has debentures of 2 lakhs. And then to creditors account. Now creditors again we will add of both the companies. So if you see, creditors of Alpha Limited are 233070 and Beta Limited's creditors are 5100. So 233070 plus 5100 means total amount of creditors in Gamma Limited's books will be 238 and 170. 238170. Okay. Assets account debit at book value including fictitious assets, but we don't have fictitious assets. To liabilities account at book value including reserves. Here reserves net balance of P&L is 294360 as done in the workings. And then to business purchase account. Okay. Assets account debit to liabilities account to business purchase account with the amount of purchase consideration 26,30,000. So to business purchase account 26,30,000. Now all of you can cross verify the total of debit is equal to credit or not. So if you do the total of debit in this entry, 5,60,000 plus 13,02,000 plus 1,91,000 plus 7,89,750 plus 5,19,780, it comes to 33,62,530. Okay, just for understanding I'm writing it here. 33,62,530 is the total of debit. Same way now all of you find out total of credit amounts. 294,360 plus 2 lakhs plus 238,170 plus 26,30,000. So all of you will find this also comes to 33,62,530. Okay, debit must be equal to credit. So keep it in mind. I repeat the entry number 2 once again. What is the entry number 2? Assets account debit. Okay, assets account debit at book value. So land and building account debit, plant, furniture, stock, cash in bank. All assets and alpha and betas, both the amounts are consolidated, added and recorded over here. Two liabilities at book value including reserves. But in reserves we have written only P&L account with 294360 because all other reserves are used in writing of the loss. So consolidated amount of all reserves after writing of the loss is 294360. Then the other liabilities are debentures and creditors. Assets account debit, two liabilities, two business purchase with purchase consideration 26,30,000. So very important entry being assets and liabilities of Alpha Limited and Beta Limited taken over. Okay, being assets and liabilities of Alpha Limited and Beta Limited taken over. Now after the second entry taking over assets and liabilities, the third entry is settlement of purchase consideration. So we will be giving the amount to the liquidators. Liquidator are the receiver, debit the receiver. So liquidator of Alpha Limited account debit with 19,50,000. The same accounts we will reverse and debit. So liquidator of Alpha Limited account debit with 19,50,000. Then liquidator of Beta Limited account debit with 6,80,000. And how is this entire purchase consideration settled? Because it is merger, because it is pooling of interest method, entire amount is settled by giving equity shares only. So to equity share capital account 26,30,000. Okay, 26,30,000 being purchase consideration settled. Okay, entire amount is paid in the form of equity shares only, so being purchase consideration settled. Now if you remember, I told you earlier also in the concepts that first 3 entries will be passed in all the questions and 4 to 7, 4, 5, 6, 7 entries are to be passed only if information is given in the question. What is the fourth entry? For issue of shares to the public. In this question we don't have any shares issued in the public. All of you can see this whole paragraph. We don't have any information about the shares issued by the company to the public. So that entry will not come. Then what is the fifth entry? Liquidation expenses of transferor company paid by transferee company. Reserves or P&L to cash and bank. We do have that as per the last sentence in paragraph. Expenses of amalgamation amounting to 15,000 are borne by Gamma Limited. So these are actually the liquidation expenses. For this the entry will be, as it is pooling of interest method, reserves or P&L account debit. Here P&L account debit. This P&L account we will use in paying the expenses. 294360 is the balance available. So write down profit and loss account debit for the expenses which are incurred. Profit and loss account debit. 15,000 are the amalgamation expenses incurred. To cash and bank account. To cash and bank account 15,000. Okay, being amalgamation expenses. Okay, being amalgamation expenses. Then next entry, as we studied in the order, was after liquidation expenses. Okay, issue of shares we did not have in the public. After liquidation expenses, incorporation and establishment expenses also are not given in the question. But settlement of liabilities we do have. What settlement of liabilities we have here? If you all see carefully in the last paragraph, it was given that 11%, 10% debentures are converted into identical number of Gamma Limited's 11% debentures of 2 lakhs. This is settlement of liability. And see here we have written also. It will affect 7th entry in the books of transferee company. Last entry. So this entry is going to get affected. But what is the entry? If you remember in the concept also I told you generally the entry would be debenture to debenture only. Why debenture to debenture? Old 10% debentures we will close and debit, and against that new 11% debentures of same value we will credit and bring it in our books of accounts. So this 10% debentures which was credited in entry number 2, against that we are giving them 11% debentures. So this 10% debentures account of 2 lakh rupees you will close and debit. Okay, 10% debentures account of 2 lakh rupees you will close and debit. Write down 10% debentures account debit 2 lakhs, and against that in the new company we are giving 11% debentures. So simply to 11% debentures account, and we are giving the debentures of same value. So 11% debentures 2 lakhs. So what are we doing in this Gamma Limited's books? The liability of 10% debentures which we credited, we are reversing and debiting and closing it, and now we are bringing a liability of 11% debentures of 2 lakhs in our books of accounts, being debentures settled. Okay, being debentures settled. Now total of journal would be done. So total of journal would be 26,30,000 plus 5,60,000 plus 13,02,000 plus 1,91,000 plus 7,89,750 plus 5,19,780 plus again 26,30,000 plus 15,000 plus 2 lakhs. So that is 88,37,530. Okay, 88,37,530. So here out of the 7 entries we have only 5 entries. Which 2 entries we don't have? We don't have any issue of shares in the public, and further what else do we don't have? Other than issue of shares, we also don't have establishment or incorporation expenses. So out of 7 entries, only 5 entries were passed in the company's books. Now journal entries are done. Other than journal entries, what is asked to you? Other than journal entries, you are asked to make the balance sheet of Gamma Limited after amalgamation. Now balance sheet means, if you all remember in company's final accounts formats, before we make the balance sheet, we used to make some 17-18 notes. I know. Now you would be thinking 17-18 notes and then balance sheet, but we have to do that. We are making the balance sheet of a joint stock company only. So before we make the balance sheet, we'll have to make that 17-18 notes. What you all do is leave 1 page format blank for the balance sheet. Okay, I repeat, leave 1 page format blank for the balance sheet, and then first we will make those notes. Okay, balance sheet should come first, notes should come afterwards. So after the balance sheet format, all of you give the heading as notes, and then we will make the balance sheet. Leave 1 page format blank for the balance sheet. Now very first note, very first liability was shareholders funds. We will make only those notes for which information is there, other notes will not make. Now in shareholders funds, very first liability was share capital. So all of you write down note 1, share capital. Now what amount of share capital? Very first we write authorized capital. If information is given in the adjustments, you'll write it, or else we will write question mark and double underline. In this question, authorized capital is not given in the adjustments, So we write question mark and double underline. Then we write issued, subscribed and paid up capital. Okay, issued, subscribed and paid up capital. Now what issued, subscribed and paid up capital will write? All of you can see in this journal entry, the share capital account is credited with 26,30,000. So 26,30,000 divided by face value of share is 10 rupees. So how many shares would have been there? 2,63,000. I hope everyone is clear with this. In this third entry, you'll get it from third entry. In this third entry, equity share capital is credited with 26,30,000. Face value of shares is 10 rupees. So 26,30,000 divided by 10. What would be the number of shares? 2,63,000. That we will write it. 2,63,000 equity shares of rupees 10 each. Okay, 2,63,000 equity shares of rupees 10 each. 26,30,000. Now we studied in the last year, second year BCom, that in disclosure we have to write in bracket if any number of shares are issued as bonus shares or if any shares are issued for consideration other than cash. Now all these shares are issued for consideration other than cash only, because this 2,63,000 equity shares which Gamma Limited is issuing, what is Gamma Limited getting against this 2,63,000? They are getting business of Alpha Limited and Beta Limited. They are getting assets and liabilities of Alpha Limited and Beta Limited by giving these shares. They are not getting cash. So you'll say all above shares are, okay, this disclosure is compulsory as per Companies Act. All above shares are issued to Alpha Limited and Beta Limited for consideration other than cash. Okay, whenever we issue the shares for consideration other than cash, then we have to mention that as a disclosure. All these shares are issued to Alpha Limited and Beta Limited against which we are getting assets and liabilities. So all these 26,30,000 of shares are issued for consideration other than cash. This disclosure is compulsory as per Companies Act. Total 26,30,000. Note 1. Now note 2. After share capital, what was the second item in shareholders funds? Reserves and surplus. Okay. In shareholders funds, the second item was reserves and surplus. So what will we write in this reserves and surplus? From all this balance sheet, entire balance sheet you'll get from this journal entries in the books of Gamma Limited. Okay, from this journal entries only you'll get the entire balance sheet. Now in reserves, we have this only one item of P&L account which is 294,360. But 294,360 credit minus same P&L account we debited for expense of 15,000. So what is the net amount of P&L account we'll write in reserves and surplus? 294,360 minus 15,000. Okay. Profit and loss account will come in reserves and surplus with what amount? 294,360 minus loss of expense of 15,000. So 2,79,360. Okay, 2,79,360 is the balance of reserves and surplus. And what do we write in that? P&L account credit in second entry minus P&L account debit in fifth entry. So 294,360 minus 15,000. Then after reserves and surplus, okay, after shareholders funds, if you all recollect, next heading on liability side was non-current liability. Now in non-current liability we have long-term borrowings, okay, or long-term debt. So non-current liabilities, long-term borrowings or long-term debt In that we have 11% debentures. Now in the new company against 10% debentures, you have given them 11% debentures. So 2 lakhs of 11% debentures will be treated as long-term debt or long-term borrowings. Okay, you all can see here, this 10% debentures account which is credited and debited gets closed. So now which liability will be there in the new company's books? 11% debentures of rupees 2 lakhs. That 11% debentures of 2 lakhs, either you can write it as long-term debt or you can write it as long-term borrowings. Okay, so long-term borrowings will include this 11% debentures. Then we used to have current liabilities. Now if you remember, in current liabilities we used to have short-term borrowings. We don't have any short-term borrowings like bank overdraft here. Then after short-term borrowings we used to have trade payables. So next note will be trade payables. Now trade payable included creditors and bills payable. Here we have creditors. So we will mention creditors from second entry. All of you can see creditors in second entry are how much? 238,170. So that will come in trade payables. Creditors 238,710. Total also 238,710. Okay, creditors of 170. 238,170 from the second entry. Every note will come from entries in the books of Gamma Limited. Now after trade payables, which other current liabilities we had? Short-term borrowings we don't have, trade payables. Then after trade payables, short-term provisions we don't have. Then after short-term provisions, other current liabilities also we don't have. Okay. In the journal entry, you all can see only two liabilities are the debentures. They come in long-term borrowings, and creditors, they come in trade payables. No other liabilities there. Only these two liabilities are there. P&L account comes in reserves and surplus. So liabilities are all completed. Now in asset side, we used to have very first heading as non-current assets. In non-current assets, we had fixed assets. In fixed assets, we had tangible fixed assets. So next note will be tangible fixed assets. What all will come in tangible fixed assets? Same from second entry. Land and building of 5,60,000 is a tangible fixed asset. Land and building 5,60,000. Then after land and building we have plant of 13,02,000. Okay, plant of 13,02,000 is also a tangible fixed asset. And then we have furniture of 1,91,000. That is also a tangible fixed asset. So what are the total tangible fixed assets? We have 13, 18, 19, 20,53,000 tangible fixed assets. Then after tangible fixed assets, we had intangible fixed assets. That includes goodwill and other items. But here we don't have any intangible asset debited in the books. So other than tangible and intangible fixed assets, we used to have long-term investments, non-current investments. We don't have it here. Then after non-current investments in the format, we had other non-current assets. We don't have it here. That is fictitious assets. Okay, so all the items are done. And we also used to have in non-current assets, other non-current assets, which include debenture, discount, underwriting commission, etc. But we don't have it in this question. So we straight away take up with current assets. Now in current assets, very first item in current assets was inventories. We don't have, yes, we do have inventories. Current investment was the first item, but that we don't have in the question. After current assets, current investments, inventories. Inventories include stock. So here stock in the journal entry you can see is 789,750. So inventories will include stock of 789,750. Total also 789,750. Then after current investments we don't have. Then inventories, then trade receivables. Trade receivables means debtors. Do we have debtors in this entry? We don't have. Then after trade receivables, cash and cash equivalents will include this cash and bank balance. So seventh item would be cash and cash equivalents. Okay, we have to write only those notes which are there present in the question. So cash and cash equivalents will include cash and bank balance. Now cash and bank, all of you can see in entry number 2, we have 519780, write it in bracket. 519780, that is debited in entry number 2, minus. Simultaneously, you'll also see that this cash and bank credited paid is 15,000 for expenses. So from this, we have paid 15,000 for expenses. So this is credited in entry number 4. So what is the net balance of cash we will have now? 504780. You always have to do this debit minus credit from the journal entries. So what is the final amount of cash we have now? 504780. Okay. Now other than cash and cash equivalents, we used to have short-term loans and advances that we don't have in this question. And then other current assets also we don't have in this question. Now balance sheet, I am just discussing. All of you need to make the format of balance sheet and put these respective items in the balance sheet. So balance sheet of Gamma Limited, very first in liabilities side, shareholders fund, you all can see now. You all pause the video, make the format of balance sheet and write down these items. Share capital, all of you can see in note 1, we got 26,30,000. So straight away share capital note 1, 26,30,000. I repeat, all of you can pause the video and record it. B, reserves and surplus 279360, we got it in this second. Reserves and surplus 279360 over here. Total 26,30,000 plus 279360, 2909,360. Second heading on liabilities side, non-current liabilities. In that we have only one thing, long-term borrowings as per note 3, 2 lakhs. You all can see here, long-term borrowings as per note 3, 2 lakhs. I repeat, all of you can pause the video and note down this. Third, current liabilities. In balance sheet, you have to write everything, even if the item is not there. So short-term borrowings are not there, nil. Trade payables as per note 4, we have got 238170. So 238170. Short-term provisions in this question, nil. Other current liabilities, nil. Total current liabilities 238170. And total of liabilities side is 33,47,530. Now asset side, non-current assets, in that A, fixed assets, tangible items in assets, we have 20,53,000. So tangible 20,53,000, intangible nil, non-current investments nil, and if you want you can write those C and D items also, long-term loans and advances and other non-current assets nil. Even if you don't write, that's okay. So total of these is 20,53,000. In current assets, current investments, if you want you can write it as nil. Otherwise inventories we get in note 6, inventories 789750. Then trade receivables are not there. Cash and cash equivalents. Okay, cash and cash equivalents, not equipments. Make it cash and cash equivalents. That is 504780 from this entry. Last 7 note you can get 504780. Then short-term loans and advances are also nil. Other current assets are also nil. So total current assets are 12,94,530. And then total of 20,53,000 plus 12,94,530, 33,47,530. So this balance sheet now you just have to copy down from the notes itself. I am writing it here. All of you can pause the video and note down this entire balance sheet from the notes. Okay. All of you pause the video and note down this entire balance sheet from the notes. So this is how you all have to do the question in the entries in the books of Transferee company. Now one more question, question 2 is in your homework. So you all try the entries of question 2 in the books of Transferee company with its balance sheet. And don't worry if you are stuck up anywhere. In the next live session of Zoom, I'll discuss the answers of question 2 in the books of Transferee company. So whatever possible you all try on your own. Okay. This balance sheet you can pause the video and finish it off. Bye everyone. Take care. See you.